Well, welcome everyone to a webinar, a CI Financial webinar. It's called Mastering Your Financial Future. We have the privilege of having two of our advisors today speaking as well. I'll MC the seminar, and we're going to have time for Q&A at the end of this webinar, and as well as it's going to be recorded. So anybody that you want to have this link to after the fact is going to be available on our website, and we're going to share it with you as well. So we can get started right away. And like I said, you're going to have time to have some questions at the end. So most of you know me already. I'm Jean-Marc Labie. I'm a president and CEO of CI Financial. I started the firm back in 1988. The company got registered in 91. So we've been going at it for quite a while now. And the focus on this particular webinar today is mainly because when I went to high school and university, I've never really had any education on financial literacy and understanding financial planning, really the basic part of it. So as soon as I got sent to the wolf, I call it, and got my first mortgage, first checking account, there's a lot of stuff that I didn't know. So our focus today is to basically give you some training on the basic financial products, and as well as some financial literacy, and hopefully you can basically pass that on as well to your kids, their friends, and then we're always open for questions. So you can read my bio if you want a little bit, but that's basically a background with me. So the goal today, we're going to cover three different things. Today's agendas, we're going to talk about the investment account. So Josh will share with you some insights on optimizing some of the products and the basic rules of some of those products as well. Yannick will discuss some strategies on financial planning, budgeting, and as well as our ESPs. And then Chris will actually provide some overview and insights on some basic life insurance, differences type of insurance products that you should have to basically cover your income. And as I refer to it from time to time, your cracks in the foundations. So I'll get started with Josh today. Josh is now a partner at CI Financial. So between Josh and Yannick, we're basically telling the news to everyone now. We've actually increased our advisors. So between Josh and Yannick, they have a few years experience as being an advisor in our firm now. And in late December, they both became shareholders and partners in the firm. So we all have an invested interest in the firm. And like I tell everybody else, if you're wondering if I'm retiring, the answer is no. I'm going to be here for quite a few more years. And I just want to make sure that if something happens to me, our main clients have somebody to chat with and talk to, and know the people that they're going to be dealing with. So that's what the goal is. So Josh, if you wanted to just get going on that, you can read his bio. I'll get you to get going.
Yeah, so the topics I'm going to be going over here today is the investment accounts here in Canada, and that's going to be broken between three different avenues. It's the registered accounts, non-registered accounts, and then we're going to talk about some asset allocation, what to look for. So within the registered accounts, we're going to be looking at the Registered Retirement Savings Plan, known as the RRSP, the tax-free savings account, known as the TFSA, the First Home Savings Account, known as the FHSA, and the Registered Education Savings Plan, which Yannick will cover in his section. The next we're going to look at is non-registered accounts, what they are, how we can use them, and how they're a little bit more flexible, and the asset allocation. So again, we're going to look at the RRSP, the Registered Retirement Savings Plan. Now, this plan is very advantageous for people making income and looking to save for retirement, as it's called, a retirement savings plan. It's very tax advantaged because the contributions to your Registered Retirement Savings Plan are tax deductible. What that means is that if you're making $100,000 and you invest $8,000, then your taxable income is now $92,000. So you're saving money on tax. This will allow it to grow tax deferred until you withdraw it. And when you withdraw it, hopefully it will be in retirement and you'll be at a lower income bracket, so your taxes will be a little bit lower. I'll have an example to show you how these work. Now, contribution limits with the registered retirement savings plan is 18% of your previous year's income. So if I made 100,000 in 2023, this year my contribution room, if I didn't have any to carry over, would be $18,000. Now, you can't have that unlimited. It's to a maximum of 31,560. In 2024 is the max you can make or put into your RSP if you're a high income earner, and that's subject to change as well due to inflation. And last year it was 30,000, this year is 31,560. So it's going to continue to go up, more inflation goes up. And then withdrawal rules. The withdrawals are taxed as regular income, but there are exceptions for a few vehicles, such as the first-time homebuyers plan and the lifelong learning plan. Withdrawals are taken as taxable because it is income used for retirement. So if you take it before retirement, you're going to be just adding to your income for that year. And here's some examples. So this next slide is, I think, very powerful, and we're going to go over it here. So this is assuming that you made $100,000. That's how much you took home, and you invested $0 into your RSP throughout the year. Your total net pay for that year after taxes, CPP, and EI is $73,271. And your average tax rate is 21.6, marginal tax rate 30.5, comprehensive deduction rate is 26.73. Now, thought process for people that have not built the habit yet of investing is that if you invest it, you lose that money. A key example to show you that investing your money actually gives you more money at the end of the year is actually the next slide. So if we look here, we made 100,000 and we're assuming that we made 100,000 last year. So our contribution availability was 18,000 for this year. This individual invested 18,000 in his RSP, which then lowered his average tax rate from 21.62 to 16.13. And you notice that the total net pay, this is the most powerful part, is the 78,000 in comparison to 73,000. So he made about 5,500 more total pay by investing because of the tax return. So what that does is it allows you to have more net pay. The government's going to pay you back for investing in your future, and then you can use the extra 5,000 that you have now and reinvest that into different accounts that we're going to take a look at. Within the RSP, there's the first-time homebuyers plan. And this is a vehicle that the government of Canada has made to allow home buyers to withdraw up to $60,000 from their RSPs, their Registered Retirement Savings Plan. Now, in previous years, it was maximum $35,000, but as of 2024, they've increased that to $60,000. And it's to buy or build a qualifying home. So if you've had a principal residence or have previously owned a residence that you've lived in, it will not work. Withdrawal limit is up to $60,000 per individual. So if you think you and your partner have yet to purchase a home and you're investing quite heavily, you can have up to $120,000 of purchasing power for your first home through this plan. Eligibility, you must be first-time home buyer, must have a written agreement to buy or build your qualifying home, and you must buy or build within the 1 year, move into your principal residence within the 1 year of the withdrawing the $60,000 or however much that you're withdrawing, because it doesn't need to be just $60,000. If you only have $20,000, let's say in your RSPs, and you want to use them, you can use the $20,000. Now the repayment terms. Withdrawn amount must be repaid to the RSP within 15 years. The annual minimum payment is about 1/15 of the withdrawn amount, so about 4% a year of what you withdrew, you must pay back. Failure to repay these amounts is going to add to your taxable income of the amount that you missed. So if you missed your payments over 15 years, so you don't repay any of it, at 15 years, you're going to have an additional $60,000 of taxable income. Now, the next vehicle that we can use to buy our first home is brand new this year. It's the First Home Savings Account, also known as the FHSA. The FHSA is a bit of a hybrid between the RRSP and the tax-free savings account. Now, it has the benefits of the RRSP because when you invest in the FHSA, it's a tax deduction, so it's going to lower your taxable income, which is a great benefit. And it's got the other half of the TFSA of the hybrid I'm talking about is that qualifying withdrawals are tax-free. So you're not going to be having to pay any taxes on this, and you don't need to repay it within 15 years. Once you use it for a qualifying purchase, buying a home, you don't need to repay it like the home buyer's plan within the RSPs. So some key information for the first home savings account is that you can only contribute up to $8,000 per year with a lifetime limit of $40,000. Now, if you max 8,000 for 5 years, you're at 40,000. The account can only be open for 15 years. So if you're thinking, I might make a lot of money in the next 5 years, so I'll be able to save up and then I'll just dump all this money into the FHSA. That won't work because the maximum carryover is 16,000 or 2 years. So if you open it up today, 2024, and you don't invest in 2024, you don't invest in 2025, and then you want to invest in 2026, you'll still only have 16,000 rather than the 24 because it only carries over to 16. Now, withdrawal rules has to be a qualifying purchase, and that's the only way you can take it tax-free. Now, let's say you don't use the FHSA within the 15 years and you have the 40,000 lifetime limit. What happens to it? It doesn't just disappear and you don't take it as income. It just rolls over to your RRSP and it doesn't affect any contribution room. So if you were at your max of your RRSP, you just get an additional 40,000. You're not going to be having any overages. So the FHSA max contribution room, we're just assuming that within the first 5 years, you did the 40,000. It could look anywhere between 40,999 if you only made 1%, all the way up to 48,000. So with compounding growth of starting early and investing early, you're going to have more purchasing power at the end. Now, in the full 15-year growth, we're assuming that you didn't really make much in the first 5 years. So you're at 40,000, barely 42 plus. But through 15 more years, you could be looking at anywhere between 69 to 96,000, even more, depending on the funds you're invested in to buy your first house. Now we couple that with the home buyer's plan, you could have up to 100, 120, 160, 200,000 of contribution of available money to purchase your first home. Within the home purchasing power, we're going to go through each account here. So the RSP room, we're assuming that we make 100,000 and each year we have 18,000. So that's our RSP room, and that's how much we're going to deposit. FHSA is stuck to 8,000. We're assuming that we're going to be doing the full FHSA every year, and we're assuming the TFSA contribution rooms don't change at year to year. They often do, but in this example, we're just making the assumption they don't. Every year, we're going to get a tax refund about $5,400. So we saw that in the previous slide, a couple slides ago, and then a tax refund from the FHSA. You're going to total refund of $7,800. Now, if we use the $60,000 from the RRSP home buyers plan, the FHSA, and then we use the TFSA, and we reinvest the tax return, say, into a non-registered account, which is an account we'll go over, you'll have a total of $192,000 for your one individual to buy your first home. And then just the FHSA and the home buyer's plan, you'll have up to 106. So we could be looking at, if you and your partner were looking to buy a house, we could be looking at 212,000 to buy your first house. Now, the tax-free savings account is a really advantageous account to use here in Canada. The contributions are made after the tax dollars, so that means that you get paid on, you get taxed on your income, and then you put this in the TFSA. The growth and withdrawals aren't taxed. Each year, you're allowed to have the next amount. So this year was 7,000. They're going to change it. Last year was 6,500. You can use up that amount. You can only start investing at 18. Now the maximum contribution limit is 95,000. The really great thing about the TFSA is, let's say I use the TFSA room up. I'm at 95,000 and I use the 7,000 this year, but then I have to withdraw it. That doesn't mean I lost that contribution room forever. So 2024, I withdraw that 7,000. The next calendar year, 2025, that contribution room gets re-added to my available contribution room plus the next year. So if we're assuming this year 7,000, next year 7,000, and I withdraw 7,000, I'd have 14,000 to invest next year. The ideal uses for the TFSA can be short-term, emergency funds, and long-term. It's really ideal. If you're retirement planning, this is a great investment vehicle because you're going to be taking income tax-free. Emergency funds are great, and short-term because you can take it tax-free. Now, if you're 18 back in 2009 all the way up to now, you'd have 95,000 contribution room. This just shows it's indexed to inflation. It increases every year. 2015 was a bit of an outlier, but it's gone up about 500. They round it to the nearest 500. Now, non-registered accounts. These are accounts that don't offer the same tax advantages as registered accounts. So you're not going to deduct any taxable income with them, but they provide a little bit more flexibility because there's no limits to how much you can invest. So if you max out your RSP and your TFSA and your FHSA and you still have money that you want to invest, a non-registered account is a great option to do so because there's no limits. Now, there are tax implications to these accounts. Earnings from these non-registered accounts, interest, dividends, capital gains will be subject to taxation. Capital gains will carry over indefinitely. If you suffer a capital loss, you can have 2-year carryover. So if you're going to do some investment strategies to try to minimize your tax burden, you can have an advisor have at least know that you have 2 years to leverage your capital losses. Now, going through portfolios and how to invest and what to invest in, some of the best approach is to have a balanced portfolio so you don't have all the eggs in one basket, as people like to say. The balanced portfolio approach involves equities, which are stocks, used for long-term growth, can be used for short-term growth. Bonds, which are fixed income, you're going to have stability with this. They're going to offer you a yield to maturity rate, cash, and GIC. So these are typically low risk investments because they offer a guaranteed amount of money, and you mix them together within these funds, you're going to have 60-40%, so 60 equity, 40% fixed income, and these funds are actively managed, so there's a 10% leeway within these funds. So if fixed income drops, we're sitting at 70-30, they're going to buy equity at a profit, buy fixed income cheaper, and balance it back out, and vice versa. So that's why it can be quite beneficial, because we can kind of get the best of both worlds. Investing long-term is important because we want to look for diversification, and we really want to have patience and discipline because it's all about time and market. But being well diversified, balanced portfolio, not having all your eggs in one basket, as I like to say, is really important, and staying patient and disciplined with your investing because it's a habit, and patient because the market will go up and down. Now, a really good example of why time and market is important is compounding growth. And that's what's really spoken about when talking about investing. So within this example, we're looking at current portfolio. Let's say you're just getting started. It's at $10,000 and you have a monthly contribution of $500. So you're 20 years old, and 35 years will be 55. With only $220,000 worth of contributions, your money would bare minimum turn into $625,000, because 5% is the minimum we look for, to maximum 1.3 million up. Right? So it's all about having that time in market, because that's not a whole lot to invest, but that's a whole lot to have in retirement. And dollar cost averaging, it's really important to invest and to have a habit of investing, and the best way to do that is monthly. And doing it monthly will allow you to save money and buy these units at a cheaper price. So we're assuming we're at 8,000 lump sum at $10. After several months, it goes back up, down at $10. Your return is zero. But if you invest monthly at 1,000 for 8 months, you have a 4.07 because you're buying at different times in the market. So it's really important to build the habit monthly because it's better for you and it's better to have that habit. This is a comparison of what we just spoke about. And if you want to take a look at it a little bit more, you can check out the Instagram. It's got a lot of good stuff like that. But that is all I have for today. So thank you for listening, and I'll pass it back over to Jean-Marc.
Well, thank you, Josh. I mean, I took a couple of things to take away from those, and I'll before the question period, I'll go back and mention that. But we'll jump right into Yannick, basically going to be talking about some of the RESPs and the financial planning part of it. And again, you can read his bio a little bit later on if you wish. But Yannick, go ahead without any delay.
Perfect. Yeah. So today we're going to talk about family planning. So we're going to discover the essentials investment strategies and accounts to build wealth and secure your family's financial future. So those some of the topics today that we're going to include are discussing strategies for RESPs, insurance, and protecting your family's finances. So the first thing that we're going to talk about today is budgeting. Budgeting is a real simple way that you and your family can track your expenses and see kind of the areas that you might be overspending. So what you want to do is, if you guys don't already have a spreadsheet, you can easily just Google budgeting spreadsheet, And there's going to be a ton of already built spreadsheets to create the best budget for you and your family. So when you're looking at a budget, you want to start by categorizing it into two different categories. So you want to track your income, take your paychecks, your government benefits, some extra earnings that you guys might have, and you want to categorize your expenses. So some things like housing, transportation, food, entertainment. So why do we categorize your expenses? It's to help identify the areas that you may need to cut back on if you see that you're overspending. So it's a great way to go through and say, oh, you know what, maybe this month here we went way too much into food and entertainment, so maybe we'll cut back on that because we want to try and focus onto our investments or different areas. So what's the importance of budgeting? One of the most important thing about budgeting is you want to start saving for the future. There are different categories within that we're going to take a look at today. So we're going to go into emergencies. So job loss and natural disasters, that's one of the areas that we want to focus on. So your goal is to aim for 3 to 6 months of income. That's just in case if you lose your job, that gives you a nice cushion to go back into and say, okay, now I can take the time, find a new job. You want to do maintenance budgeting. So if you guys own a home or you guys own a vehicle, you want to take 1% of the value of your home and you put it away for maintenance. Same thing with your car. So if your home is owned at $400,000, you want to take $4,000 of that a year and put it away because you never know. You might have to replace the roof in 5 to 6 years, and that's an expense that costs about $10,000 to do. So big purchases is another one that you want to put stuff away. So new home, new car, renovations, vacations, and weddings. Big purchases are something that we can even open accounts on, like Josh touched on, for non-registered accounts. So that'd be a good one to go into that. Then we've got long-term goals. So you want to save for retirement, pay off your debt, building emergency funds, or saving for a down payment. Educational funds and RESPs is something that we're going to expand on a little bit earlier or a little bit later here as well. So this is a great example of the type of spreadsheets that you can find online. I literally just Googled spreadsheets for budgeting, and this one came up. At the top there, it's got a great example of the income. That's the total income that they have per home, and then they break down the expenses after that. And then at the bottom, it says what's left for expenses. So every month you would review this spreadsheet, put in new expenses that might come up that you didn't think about before, and this will be a great job, or this does a great job to just track all the different expenses as well. Now we're going to jump into RESPs. So what is an RESP? RESP stands for Registered Education Savings Plan. It's a tax advantage investment account to help you save for your child's post-secondary education. And there is a wide variety of programs to qualify for RESPs, such as undergraduate studies, so college or university, vocational or trade schools, apprenticeship programs, and certain educational programs even offered outside of Canada. So there's a wide variety, so you don't have to worry too much about it as well. So the most important thing about the RESPs is the government grants and the bonds. So every time that you put $1 in, the government will match that dollar for up to 20%. So CESG, the Canadian Education Savings Grant is what it's called. They will match up to 20% of your yearly deposits to up to a total of $2,500. So every $2,500 that you put in every year, the government will match $500 of that per beneficiary. So if you guys have more than one kid, you go ahead and put $2,500 per kid for the year, then you're going to get $1,000 from the government as a grant that's matched for every kid. So there is a note to say that there is a total max of $7,200 for lifetime amount per beneficiary. So no matter how much money that you put in, if you put in the full $50,000, the government will still only match a total of $7,200. So if you put in $2,500 per kid, they will match it for 14 and a half years and nothing after that. So it's a lifetime amount of $7,200. So when you're opening up an RESP plan, you can choose between two different types of plan. There's an individual plan and a family plan. So what is an individual plan? An individual plan, you can only have one active beneficiary at all times. Anyone can contribute to this plan. So if you've got cousins, brothers, they want to contribute to the plan, they're more than welcome to contribute for that beneficiary there. The beneficiary can be at any age. So if you want to open up RESP account for someone that's 25, 26, or 27, then they're more than welcome to do that. You would have to open up an individual plan for that. You can make contributions for up to 31 years after the plan is open. So what that means is this type of plans are recommended for single child families or families with a large age difference between kids. So if you have a brother that's 21 and then your parents just happen to have a kid at 0 and he's already gone to school, you could open up an individual plan for that new baby coming in as well. Or if you want to set up an RESP for yourself or someone you're related to. So if down the road you want to say, hey, I'm going to school in 10 years, but right now I'm going to work my way through it to put myself through school, you can open up an RESP for yourself and do deposits as well and get the grant from that too. So a family plan, you can name multiple beneficiaries. So if you guys have one or more kids, then you would open up a family plan. All beneficiaries must be related to you by blood or adoption. So you cannot open a plan for anybody else under a family plan unless they are by blood or adoption to you. When the plan is open, the beneficiary must be under the age of 21. So if you're opening it for your kids, you'll most likely start, the year that they're born, and they had to be under 21 years of age. The contributions can be made for the beneficiary until the age of 31. So you can contribute until they're at the age of 31, but they have to be under 21 in order to start the contributions. So the RESP plan can be used until the beneficiary turns 35. So once your kid turns 35, that is the last year that you can use the RESP plan to put your kid through school. So these type of plans are recommended for single families planning to have one or more children. It is important to note that the CESG, so the government grant, can be shared between beneficiaries. So if your older kid, goes to school or doesn't go to school, and you want to use the grant, you can use the first kid's grant as the second one as well. So we'll go into that more in detail in the next couple slides here. So how does an RESP plan work? So kind of what we talked about earlier, you open up an RESP account and you choose between either an individual plan or a family plan. So you can make either one big lump sum contribution a year, or you can split it off monthly. Cindy says she cannot see the slides. Is anybody else having that issue? Okay, well, I will keep going here and then you guys let me know. Oh, okay. Okay, perfect. So the one thing that you want to make sure is that you get this CESG matching, so the government bond matching. So one thing that we do as advisors here is that we automatically lump that all together with the paperwork to open up a RESP account. So it's important to note that you can only contribute until the year that they turn 18 with the family plan. So the year that they're 17 is the last year that they can contribute to the plan. The year they turn 18, you can't contribute anymore for the government grant as well. The lifetime contribution amount is $50,000 per beneficiary. So you cannot go past $50,000. The government will not let you in your RESP plan. Even if you try to put $50,000 in one, they're not going to allow it. So it's a max of $50,000 per beneficiary. So one of the big questions that we usually have is, can we catch up missed contributions amount? So if the first 2 years you've opened up the RESP, but you forgot to put any money towards it, you definitely can catch them up. So you can catch up contributions if you miss them. So you can only catch up 1 year at a time though. So if you've missed 2 years of contribution, that means you've missed out on $1,000 of the grant. Making up this timeline, it will take you 2 years. So it'll take you 2 years to catch it up. $5,000 of deposits per year per beneficiary that you guys have missed. So $5,000 1 year deposit, so $2,500 for the current year and $2,500 for the year before that. That'll give you the $1,000 grant that you've missed out on. And then you'll repeat that same process for another year to catch up the 2 years that you guys have missed. So RESP withdrawals, one of the big questions that we usually have that makes people hesitant to want to open up an RESP is, what happens to the money if my kids don't go to school? It's a very valid question, right? You guys put a lot of time and effort and money into wanting for them to go to school. If they choose not to, you don't have to worry about it. One of the options that you can do is you can leave the RESP open. You never know if your kid's is gonna go to school later in life. So if you don't need the money right away or transferred into your RSPs, then you can wait until they turn 35 years old, which is the last year that they can use it. And if they don't use it, then you can go ahead and shut down the account. So when you shut down the account, there's three things that happen. You have to return the grant to the government. So the $7,200 that you guys get as grants has to go to the government. It wasn't your portion. It's not your money. So you just got to give that back. It's no problem. You have to transfer out the growth back into your bank account as long as one of the following conditions are met. The beneficiary is at least 21 years old. The RESP has been open for at least 10 years. The plan has been open for 36 years, and the beneficiaries are deceased. So one of those, it's fine. You can get the grant, the growth back into your bank account. You can also transfer out the principal right away. So if they turn 19 and they decide, I don't want to go to school, you can transfer out the principal with no stipulations. So the principal can be transferred either to an RRSP or a spousal RRSP if you guys have the tax room. If not, it can just be transferred back to your bank account tax-free, and you can decide what you want to do. If you want to open up a non-registered, kind of like Josh was talking about earlier. So these are kind of my top 5 that I recommend to clients for tips when opening up an RESP. Is you want to start investing early. You want to take advantage of the power of compounding interest. 2, you want to make it automatic. One of the best ways to get in the market is using the cost dollar averaging system. So monthly payments is one of the best ways to get in the market because you can either get it high when the prices are high, and you also get them when the prices are low. Number 3 is you want to maximize the grant money. So aim to get the full $7,200 per beneficiary in the RESPs. One of the main reasons that is for like number 4. So you take advantage of the grant when doing withdrawals for education. Each beneficiary can use up to $7,200 as long as the grant funds are in there. So the first thing that we do when we pull funds out of an RESP is we pull the grant money first. Because it's not the money that you guys worked hard for to put in there, they're pretty much just there up for grabs. So every single beneficiary can use up to the full amount of $7,200, right? So if you guys have $14,400 into the RESP account, one beneficiary can use the full $7,200, but not $1 more. After that, you got to go to the growth and to the principal for that. So number 5 is use the growth to pay for school since there is no limit. So if the growth of the account is sitting at about $30,000, you can use that growth for any single of the beneficiaries. So you can go ahead and use it for school before even touching the principal. So here is a good chart of the power of compounding for the RESP grant. So the monthly contributions for this are $208. If you times that by 12, it's going to give you the $2,500 that you guys get for the year. So that means that you guys are getting the full grant of $500 from the government. So all of those add up to $250 a month that's going into your RESP accounts. If you're averaging a 5% return every year for that, you can see that at year 17, one beneficiary is going to have $80,465 to play with to go to school. So that's a big amount, right? But one of the important things to note is that if you guys start late and you don't do the catch-up contributions, and say you miss out on 3 years of the contributions, right? So that means that your beneficiary is actually going to be getting 14 years, so 60,902. So it's real important that we start early, start the year that they're born, because you can start 15 days, you can start contributing 15 days after your kid is born. That's when you can open up the RESP and start putting money into that for their future as well. So Chris is going to expand on the importance of these topics for the insurance topics and what they are. But I just wanted to highlight some of the important types of insurance that you and your family may need to keep yourselves protected. Number 1 is life insurance, critical illness, disability, and health benefits. So securing your family's future. Like we talked about, budgeting and savings. You want to ensure a strong financial foundation by creating a budget and prioritizing savings. RESP and education funding. You want to leverage the government grants and bonds to maximize your child's post-secondary education and savings. Insurance planning. Protect your family's finances by selecting the right insurance that covers your needs. And you want to have ongoing reviews and adjustments every year. Regularly review your financial plan and make changes as your family's circumstances evolve every year. Now, pass it on to Jean-Marc.
Hey, thank you, Yannick. Great information on the RESP. Again, I took a few takeaway from that, which I'll cover at the end before the question period. Now I'd like to introduce you to Chris Geldert, and I've known Chris for quite a few years now. He's really a specialist in the advanced life insurance market, and I think he won't be challenged too much today on the basic of insurance coverage, but it's fun to basically go through. I've been working with Chris for quite a few years now on basically basic advanced cases, and so it'll be fun for you, Chris, to just talk about basic today. So I'll let you go ahead and enjoy.
Yeah, absolutely. Thank you, Jean-Marc. And I will say is that I think between you and myself, I think we both need to update our pictures. I have a little bit more gray than the last time that I had my headshot, apparently, but we'll work on that. So as Jean-Marc mentioned, I'm just going to go really high level in terms of, what are some of the insurance that's available and where do we see it fitting within families? A lot of the work I do also incorporates business owners. So working with assets that are maybe trapped inside a business. A lot of times when we're talking about insurance, especially life insurance, there's some insurance that families absolutely need. And then there's other insurance that perhaps that they want to sort of better their overall family position going forward. So whether we're talking about our children, grandchildren, etc. If I don't know if I have control over the slides, but if you just forward one more slide, in terms of needs, really there's three common needs when we're talking about life insurance. And the first one is about protecting the family. And we think about, what's our biggest asset that we have that needs to be protected. If I ask, most Canadians would come back and they would say probably their house, or they might say their car. They're going to say a physical asset, where if we think about like what is our biggest asset that we have, it's ourselves. It's our ability to earn income for our family. It's our ability to provide for our family. So that's the first one. And when we're talking about, protecting family, really we're looking oftentimes of a temporary need. As we get closer and closer to retirement, hopefully we're saving along the way. Josh, you did a fantastic job in terms of, save early. The earlier you save, again, that idea of compounding interest. Yannick, same thing. And really what we want to do is we want to just make sure that if something happens and that family member is no longer there, that the family can continue on and they have the resources to continue on. The second one is protecting the mortgage. If you have a mortgage and you've dealt with a bank, chances are that as part of the process is they talk to you about, well, you should probably have life insurance to cover your mortgage. There's mortgage that is offered from financial institutions, i.e. the bank that is offering the mortgage. Those are designed specifically to protect that financial institution, not necessarily for the family. There are other term coverages that are set up at the beginning that you have full control over, whether you want to change to a new company with a mortgage. We're seeing a lot of that, obviously, with a lot of mortgages coming up for renewal. So we want to just make sure that we have the proper protection in place. The last one, if you're in business and you have partners, one thing that we would look at insurance is, well, what happens when one of the partners passes away? Do we need to make sure that there's liquidity there in order to buy out the deceased partner, provide some liquidity for the family? These are all temporary in nature. So these would be what I would classify as what we'd use as term insurance. So Josh, if you just go to the next slide with term insurance is affordable. Part of the benefit of term insurance not only being affordable is the idea that we can actually convert it to something permanent. So something that's going to be there a little bit longer in nature at some point down the road. So we can consider that being is maybe we're securing our insurability. From an insurance perspective, it's more than the fact that maybe you want or need insurance. There's a process, and the insurance company is obviously looking to make sure that they're not taking undue risks when they're covering somebody. So they're looking at the health of an individual. Really, everybody has invisible sand in the line of life, and as we're going through, at some point we cross this point, and at that point going forward, for most Canadians, is maybe something has happened and now we're uninsurable. So it's really important to get this protection in place while we can, while we're healthy. The younger that we get it, obviously, the more affordable that it happens to be. What happens with term insurance, however, is if we're going to secure for a period of time, that next period of time, the cost is going to escalate. And depending on the structure, it could increase anywhere 4 to 6 times, or it might just slowly step up each and every year. At some point, it's going to come to a point in time where the cost of the insurance is not going to make sense financially. For most Canadians, there comes a point in time where they allow for that protection. It's no longer needed, so I'm going to let it go. If you live long enough, the coverage will stop automatically. So depending on the insurance companies, it's either typically age 80 or age 85. If you're able to make and you're able to afford all the premiums up to that point in time, you live long enough, eventually the insurance company says, we don't want to take the risk anymore. So we're just going to cease the coverage at that point. Now, so those are the needs. Now, when we look at the wants, Canadians who want insurance, we're either looking at how can we preserve the assets that we have, how can we build the assets that we have, or how can we enhance the assets that we have. And I'll talk about the equalization after, but if we just focus on the first three. So this idea of preserving assets, in Canada, when we pass away, we're deemed to dispose of all our worldly assets. This is the government's last kick at the can in terms of making sure that everybody kicks in taxes. It does help that deceased people don't vote, so they tend to focus on them a little bit more. So if we're just deemed to dispose of all our assets, if you have things like rental properties, if you own a cottage, if you own a cabin, if you have a business, if you have assets that aren't necessarily liquid, you're still deemed to dispose of it, but there's no money coming in. So here's where insurance can play a role, is to really create that liquidity at the time that it's needed. Unlike temporary or term insurance, we know that this event's going to happen. We just don't know when. So we're going to look at maybe a little bit of a different type of coverage. But really what we're doing is we want to create that liquidity so we're not forced to sell specific assets. We're able to transfer those assets to the next generation. Perhaps we want to build assets. Life insurance, unbeknownst to most Canadians, includes a tax sheltered component. So it includes an investment component, which we'll touch on. Or perhaps there's an enhancement of the wealth. There's been a lot of talk in the last couple of days for sure, but even leading up to that with the latest federal budget, there's a proposal about increasing the inclusion rate for capital gains tax. Now, for most Canadians, that's not going to impact them. Where it will impact them is obviously on death, because we're deemed to dispose of all our assets. That's typically our largest tax bill that we have. But it also impacts business owners. So if you have a business and you're investing in your business, the change is actually going to create and force more taxes. So maybe there's a way that we can use life insurance to create a little bit more efficiency and enhance the overall estate for the next generation or the generation after that. The idea of equalization, this comes into play a lot where whether we're dealing with farms or whether we're dealing with businesses, the idea that typically that one child might take over a business. And if you have multiple children, is how do we address and how do we deal and make sure that there's adequate assets for the other children? That's really where the equalization comes. In terms of part of this idea of maximizing wealth. So Josh, just the next slide there. And again, really just to really just emphasize, what Josh and Yannick were saying about this idea of investing early, this idea of compounding. So I use this example a lot in my presentations. If I gave you $1 and you took that dollar and you were able to invest it and generate 100% rate of return, so you were able to double it each and every year. So in the second year, you had $2, third year, you had $4, and it went to $8, and then to 16. At the end of the 20th year, you would have $1,048,576. So you start with $1. You put no more money in. You just double it each and every year for 20 years. You end up with $1,048,576. Now, if we take that exact same example, $1, we're investing it, we're generating 100% rate of return each and every year. But this time the government comes in and they take half of the gain each and every year. We go from $1,048,576. That gets reduced to $3,325. So that's the impact that taxation has. So if there's tax shelters that we can take advantage of, whether it's an RSP, whether it's an RESP. Another big one in Canada is our primary residence. So if you own a house and you sell it at some point in the future, the growth and the gain on that is shelter from tax currently. If you go one or two more slides, Josh. One that's often overlooked in terms of a tax shelter is this idea of life insurance. And when we talk about life insurance from an investment perspective, and when we're talking about insurance from a wants perspective, whether we're preserving, whether we're building wealth, whether we're enhancing wealth, we know that this isn't a temporary situation. We know it's a permanent situation that's going to be there until we're no longer there. So we're going to start looking at some permanent life insurance type coverages. In Canada, we have 3 types of permanent life insurance. The first one is called Term to 100. Very much like just term insurance, except it's going to guarantee or fix that premium to your age 100. So for your lifetime, it's going to fix it. There is no ability to invest within it. It's pretty vanilla. It's you need a death benefit. Here's essentially the cheapest cost is typically where we would see the Term to 100. The other big one is universal life. So with universal life is you have an investment component and you have a lot of flexibility. You have flexibility in terms of how much you can contribute each and every year. But with that flexibility comes a lot of control. And the control really comes to is how much am I going to contribute each and every year? If I'm going to put it towards the investment, that investment needs to be managed. And there's a lot of different investment options everywhere from guaranteed to traditional type mutual fund type investments. The idea being, though, it still needs to be managed. The third one is whole life or participating life insurance, something you might have heard of. With whole life and with participating whole life, you're giving away some of the flexibility. So there's a higher threshold in terms of how much am I going to contribute each and every year. The benefit, though, being is, number one, there's a lot more guarantees within this type of product, both in terms of the payout upon death, but also in terms of the investment itself, in terms of how it grows. From the insurance perspective, or the insurance carrier's perspective, is all the premiums that come in these products is they put them into a big pool. Some of the insurance companies in Canada have well in excess of $1 billion to invest. So because they have these massive amounts of funds to invest, number one, they're able to hire professional, really strong professional portfolio managers. Number two, because they have the wealth, because they have the ability to invest this money, and they have these $1 billion plus portfolios, is institutional type investors come to them. So investments that a typical Canadian may not get access to, they get access to. The advantage is they take very little risk. They get a relatively high yield without taking that risk. And what ultimately happens is that just the benefit just grows over time. There's a guaranteed portion, there's a dividend portion. Once that gets paid, it gets locked in, can never be pulled back. You can never have a negative. So this becomes, this is what I would call safe money or boring investment. It's just going to continue to grow. The more that you have in this boring type investment, the safe investment, the more risk that you can take elsewhere to maybe get a bit better of a return. So if we just go to the next slide there, Josh, where we see this type of product being used a lot within corporations where assets are effectively trapped. If you want to get access to it, you have to pull it out. You have to pay taxable dividend. You pay tax on it, means you have less to invest. So we do see it a lot inside corporations taking over from fixed income type of investments that are taxed at a really high level, tend not to generate a really good rate of return. Long term, these type of products generate a 4.5 to 5.5% net rate of return. So if we're in a 50% tax rate, that's the equivalent of about 9 to a 10% GIC type of investment. So again, it can be very attractive for replacing maybe some of the fixed income in a portfolio. And there's a number of different ways to access this cash. For now, I'll kind of stop there from the life insurance side, and I'll just sort of transition a little bit to critical illness insurance. So critical illness insurance, unlike any other type of insurance, was created and developed by a doctor. It was developed by a doctor from South Africa. Him and his brother, they did the first heart transplant in South Africa back in the 60s. He was a very big proponent in terms of he had a lot of patients that he could heal the physical, but what was ending up happening are clients were being forced back to work. And so this is the premise behind critical illness. I typically lead with three questions. I'm sure everybody knows somebody who's suffered from a heart attack, cancer, or stroke. In all circumstances, or most circumstances, it's unexpected. You probably have, that one person who's like, well, that's the healthiest person that I've ever met. And, they had a heart attack, or they had a brain tumor, or they had a stroke. There's a lot of factors that go into it. And a lot of times, for the most part, it's unexpected. But really where critical illness comes in is it provides a tax-free lump sum payment. And, for anybody that, that has gone through this, or you've gone through this, really, I would just ask you is, do you think that, having an influx of cash at that point in time, I use the term eliminate financial stress, maybe alleviate is probably a better term, but just allowing them the time to get better, right? Not being forced back to work, not being forced back into a situation that maybe created the stress that created the heart attack. So again, I would really give strong consideration. This is a very big part of financial planning. Josh, if you just go to the next slide, please. And again, just imagine if it was yourself or it was a loved one. Do you have the ability to take that time to heal? Yannick was talking about, setting up that emergency fund, that 3 to 6 months. Well, if you're drawing down on that, you're going to ultimately have to replace it. So maybe there's a better way. And again, that's this whole premise of having this protection in place. The last thing you want to do, however, is have to draw on maybe your registered funds or the money that you've set towards retirement. It has a dramatic impact if you start pulling those out early. So why not have this that can ultimately have this tax-free payment? There's a thing called return of premium that we can add to it. So after a period of time, if we're able to set aside enough money, you can actually get all your money back if you don't utilize this contract. So for most Canadians, this is by far and away the most important part, in my opinion, of an overall financial plan, and has definitely become more important in the last 20, 30 years. Medical advancements, defibrillators everywhere you go. Things like cell phones. You're able to call the ambulance. You don't have to go and scrounge and find a quarter in order to find a payphone to call the ambulance when someone has a heart attack. It's done right away. So we are seeing that, we have the same, we have heart attacks, we have cancers, we have stroke still happening. It's just medical improvements, access to resources much quicker are allowing us to survive these events. And then the last one that I'll just touch on, and this is especially if you're an employee, this idea of disability insurance. So critical illness is if you have heart attack, cancer, stroke, number of other different ailments, disability covers part of that, but really you're not able to work. It could be it could be stress related. It could be just due to some kind of breakdown in the body. In that event, there's a monthly payment that is made to help the family along where you're not able to go into work. If you have a group plan, the only thing I'll leave you with is have a conversation with your financial advisor. Have a conversation and really determine how much is that coverage providing. You might be very surprised or shocked in terms of maybe it doesn't cover what I think it's going to cover. They typically are topped out at a certain level. And if your salary, it may only cover your base pay, it may not cover overtime. There's a number of different things that restrict the payment. So there's definitely top ups that could be considered. So with that, I'm going to pass it back to Jean-Marc.
Well, great. And again, thank you, Yannick. Thank you, Josh. And thank you, Chris. Again, this will be posted on our website. We will send some information to you. And thank you for participating today. It was great hosting it for you guys, and I hope you enjoyed it. And if you have any questions, our email address is there, our advisors' names are there. Feel free to send us some information. Until next time.
For attending. Yep.
Yo.